Ladies and gentlemen, lunch is coming. There is going to be caffeine and all sorts of treats coming, but I do ask you to hold on because when we talk about the gold rush, the sugar rush is coming, but the gold rush is already here. And actually, from a panel perspective, you've actually got some real rock stars here. They're going to be able to give you some insights. So there may be the odd F-bomb, so if that kind of percolates around at all, but this is going to be super authentic from people that are out on the field building the forefront of FinTech and financial services. And we've got about 40 minutes, and so hopefully we'll make it super fun for you. As we build through the landscape, we know that whilst there's been the talk over the years of the FinTech boom and then the kind of supposed bust where all the VCs seem to have run out of money and they've got very short arms and very long pockets. And so the move to profitability, the move to making every dollar count, so whether that's reducing headcount or growing size of market, that's also then blended in with the fact that post COVID, we've seen a boom in payments, we've seen a boom in transactions, we've seen a boom in people having disposable income, and therefore, whether that's a meme coin, whether that's putting money into funds and fund management, but we've seen almost a bifurcation in the market. Those that have cash have more cash than ever, and those that don't have cash and resources have less than they've ever had. And so that presents a unique opportunity for the 1% for those that are building. There's also an enormous opportunity to help those that are often the 99%, the left behind, whether that's in getting on the property market for the first time in what's a very difficult economy, or saving for the first time. And so we've got a really strong mix. But as we get into it, I'm gonna start here because as we talk through the days of, is it, do you serve a certain market, or does everybody become a financial services player? Anthony, delivery hero. You wouldn't normally think of it as a financial services business. So I would love to know what keeps you up at night, and how has Delivery Hero become one of the pioneers in FinTech?
Let me start by saying that we aren't a financial services entity. Delivery Hero is the parent of Talabat. We have food and grocery delivery businesses around the world in about 70 plus markets. I happen to lead the FinTech vertical within Delivery Hero, which solves problems for our own ecosystem. And a lot of FinTech businesses have been birthed out of solving problems for marketplaces. Ours also has gone down the path of solving first for payment enablement and how to make that frictionless at the lowest cost possible for our platforms. And then beyond that, in trying to improve engagement of our end customers, our restaurants, our shops, and the riders who deliver. And the way we do that is through other financial services offerings, whether it be wallets, where you can store some value and it makes the payment experience seamless, or in some cases, credit products, both for consumers as well as for restaurants again, where in some cases we're embedded in the consumer payment. And we had Tommaso, who's the CEO of Talabat, which is one of our best companies in the portfolio, talk about how there is unevenness between the purchase patterns at the beginning of the month and closer to when your income dries up, and therefore credit products play a certain role there. And on the other side, for the mid to long tail of restaurants, in other parts of the world, in fact in South America, in Pedidosha, we have an active program where we allow our restaurants to take credit based on not your traditional means of underwriting, but really based on how much business you do with us. And not only do we have more data about their business over time, but we also sit on the funds and therefore have an efficient means to collect. And in this mix, we're able to provide them with solutions they would not have otherwise had access to at a cost that is far more affordable. So these are some of the examples. What we also do is we're careful not to stretch ourselves beyond our mandate. So we must serve the global platforms better. And where we feel that solutions are required, and we don't have to provide it ourselves, where when you get into the regime of licensing and financial regulation, you'd rather partner with either a bank or a wallet in some cases, a card issuer in some. We have these co-branded partnerships. So that's the range of things we do in Delivery Hero.
So I'm fascinated by that, because if we go back to that bifurcation of the world, when you say we do things that are different, we try to make things easier. Are we now, with everything becoming a FinTech, are we encouraging people to spend beyond their means? If you provide more liquidity in the checkout, are we moving to a world where people are choosing, ultimately you want a greater share of wallet, I'm assuming, to grow returns and build your shareholders. But does that mean, Mark, and if I can bring you in here, does that mean that consumers now have less to save and less to invest because they're actually being incentivized to spend more of their disposable income on things that are, buy now, pay later, or in-app shopping?
I think so. I think it's possible, and a lot of FinTechs, we have the role to educate, to have the right products that match a certain demographic. So that being said, it's a big mission to ask one FinTech to educate the whole market on proper financial habits. So everyone has a role to play in it. So I wouldn't say I wouldn't label it as right or wrong. FinTechs typically focus less on advice and much more on enablement.
Okay.
So in our role, we started as a robo-advisor, where initially we provided diversified portfolios of index funds and thinking long-term. We learned that with time, people want the power to decide on their own journey, whether it's crypto, self-directed stocks, and now saving accounts. So I see us much more playing a role in enablement than trying to steer in the realm of right or wrong.
So there's only so many dollars per month to go around per consumer in the region. So, Jigar, if I think about you, I guess being part of Morgan Stanley, do you win whatever happens, right? More capital, more debt, more liquidity, whatever happens, you're on every side of the trade. But where are you pointing your guns internally? What gets you where are you trying to allocate resource to kind of grow what you're doing day to day?
Sure, Tom. And I'll refer back to, if you go up and down in our elevators in our building, we have a great motto that says capital creates opportunities. The market is efficient. The market is all about reallocating capital and where it's needed the most. And so, for the moment where we're focused internally, at least on the FinTech side, is getting capital to the companies that need it the most, in this case, in the private markets. Yeah. If you go back to 2020, 2021, it was focused on bringing companies to the public capital markets. Given those markets have been relatively shut for the moment, it's focused on the private capital markets at the moment.
So when we talk about the kind of scale, bringing you in here, Jason, kind of scale of liquidity, and that's it, given your global perspective, and we talk about there's a real credit crunch now in the capital markets, there's a credit crunch for consumers. What are you seeing? I think you've got a particularly global view that not many of us have.
Yeah, thank you. And I'd like to go back to the other comment, too, about the importance of saving, right? And that's, I think, all of our responsibility, as you were talking about, of educating the consumer on not just spending and playing to our vices of wanting to buy everything, but if you're looking at, credit card debt in the United States is now, accelerating at a faster and faster and faster pace. And ultimately, the space that we, play in is really the protective investing space. So we might be the most exciting and also the most boring company up here because we are here to preserve your wealth. And that's ultimately what Halo does. And so we are a two-sided marketplace that is disrupted and democratized, to use two words that I dislike because they're the most overused words, but a $3 trillion market called a structured note. And ultimately what structured notes do is that they provide investors a level of downside investment protection against market declines while still allowing them to participate in the majority of the upside. So think of it as insurance, around your investment. While what we do is important from an impact perspective is not just the democratization for the sake of democratization, but if you look at America, talking about your global perspective, what a lot of people don't appreciate is that the median savings rate in our country is $63,000 going into retirement. $63,000. If you look at the average, it's about $300,000. So what we read in the headlines of the Wall Street Journal and Bloomberg about our consumption power and our consumption behavior within the United States is not necessarily the reality for the majority of Americans. And so ultimately, to be able to bridge that wealth gap that we're facing in the United States and countries all around the world, as you pointed out, Tom, we are a global company and we operate around 5 continents. We do over $10 billion of transactions every single year after just being live 5 years. It's about educating on the importance of savings, offering that downside investment protection. And you're starting to see that more in the market now, not because of higher volatility, but it just gives us a chance to be able to have our portfolios outlive us versus the other way around, which is all too often. Again, not just in the United States, but around the world.
And so, Anthony, I'm really fascinated on something you mentioned about the enterprise side of things and how you enable those that effectively the creators, the entrepreneurs, to be able to effectively distribute their products via your platform, but how you're bringing credit and structured products to that. Because if I go and launch a new shop or a restaurant or something, there's no way I'm going to be able to call up Jigar and say, yo, by the way, I just need a little bit of a line just to kind of buy my materials and do that thing. So, I'm fascinated by the power, and when we think about the next wave and the new gold rush, the picks and shovels to be able to enable someone to turn up in a new territory and be able to access your tools of distribution, but now your tools of liquidity. And particularly when entrepreneurs are looking to build, I think we're moving, the next wave is moving towards building for the enterprise and has much more scale. And so I'll be interested in how you think about the enterprise play rather than your B2B business, rather than necessarily your consumer-facing business.
Sure. So the good thing is, again, since we sit in the middle, we do get to serve both sides. And with the small businesses, particularly the mid to long tail, that's where I think there's a lot of need. And we operate, remember, in 70+ markets, and we have the whole range, but there is a concentration in emerging markets. And this is where the credit access is limited. And here's where we feel, again, to solve our own problems, right? Because we do want to create engagement and stickiness for these restaurants, because it's in their success that we will continue to lead. And here's where we've picked markets deliberately where we do actually solve that problem, and we've tried to do it in a way that is frictionless. Because ultimately, what do? For anyone in the financial services business, we're either trying to help you spend or send money, borrow, save or invest, or protect, right? And therefore, if we do have access to this population, there are a lot of financial institutions that cannot serve that part of the population because it's just there are barriers. There's a high cost of acquisition, they don't have documents, and the like. And that's where we feel that if we are sitting here in the middle and we're enabling traffic and we're enabling the delivery of their ware, then why can't we use all of that data, and why can't we use the fact that we see a pattern over time to make it easier for financial institutions to extend credit to these borrowers? So we don't try and do too many things on our own. We do take, in certain cases, short-term payment deferral facilities, but that's where, again, we're talking about ticket sizes, let's say in Argentina, of $1,500, right? And for a tenor of maybe 2 weeks, right? Where it's really to bridge supply, because there is just this need. And then we do it in other countries in Latin America and other parts of the world, because we just feel that we can. So it serves the core business, but at the same time, it creates a healthy stream of future revenue for the company.
Yeah, I'm fascinated by that. And so in the same way that we now open Kareem and we can pay our Etisalat bill, do we see a world in which we can open Delivery Hero and round up and save with Sarwa or Halo? Is that kind of the long-term plan where you'll have your own products and then you'll become the super marketplace?
Well, that's what I was going to piggyback off of what Anthony says, and that's the beauty of ultimate FinTech and innovation, is that you can take important lending solutions in markets where you need microfinance loans. And if you look at microfinance loans, they actually have a payback typically of over 90%. because the community relies so much on those microloans, they're never going to not let your brother, your friend, your cousin not repay back those loans. And so with what we do in regards to a structured note, at the end of the day, a structured note is just a bond and an option. Yeah, Morgan Stanley offers them on our platform, and UBS and Bank of America, everybody else. But why can't we take up microloans and package those together and be able to offer them out to all of us? So we're able to use our dollars not just to stuff the wallets of banks, which we're very close partners with, and they play a very important part of the ecosystem. But if you can give me a package of microloans that has a very low probability of default, that's also insured by, say, a major insurance company, that reduces the cost of those interest payments that those folks who rely on them by over 40%. Wouldn't you want to buy that investment product? Right? So you're still getting downside investment protection against the market. You're still getting the upside against the market. And at the same time, you're doing something with fiscal responsibility by allowing to lower the interest and debt servicing payments of people, the farmers, the bread makers, within Latin America, within South America, in the United States of America, all over the world. And I think that that's the beauty of ecosystems like ours, is you can use your scale to be able to do good. Not to be on my social soapbox.
Jigar, if I just bring you in for a second, you sit at a really interesting position because you're product focused within the fintech space, but you have the power and the firepower of the world's biggest banks behind you. Do we see a world, or do you see a world in which you build internally products, or are you still buyers? Are you basically out there acquiring front ends and using your firepower underneath those? So you've got a number of consumer-facing people that are building the front ends, whilst really it's the power and strength of Morgan underneath.
Yeah, Tom, it's a very interesting question, because we at Morgan Stanley, but I'm sure many organizations go through it as well. It's the classic buy, build, partner approach. And every matrix you go through, it's, should we buy this? Well, it may be too expensive, may not be the right fit, integration challenges. Should we partner? Who do we partner with? And then if we build it, how long is the build going to take? And I think that analysis is now coming into the boardrooms, the management, executive committees on almost every single product, business area they think of, okay, we need to take a buy, build, partner approach. The world is moving so fast, you simply cannot wait multiple years to bring a product to market, because you'll get lapped by competitors or disruptors. And so if you look at Morgan Stanley, for instance, we've developed some products internally. We've bought some stuff like E-Trade, Eaton Vance, others externally, and then branded them into the Morgan Stanley family. And then there's other places where we partnered. And I think that is going to be an ongoing just analysis and protocol for many organizations on how they partner with fintechs, how they build against fintechs, and how they acquire fintechs. And we, when we are advising fintechs on a sale mandate or advising strategic buyers on a buy-side mandate, we go through that exact same analysis of how quickly can you build it, how quickly can you partner, and what does it bring for you, and then how much does it cost to buy it.
And so has your inbox transformed from a buy-side mandate, say 24 months ago, to a sell-side mandate where everyone's coming to you saying, find a buyer, find an investor for us? I'd love to hear what you're seeing come across your desk. Are we bullish? Are we bearish? Where are you seeing and feeling the temperature of the market at the moment?
I would say, and I'm an optimist by heart, so just take that into consideration, but I'm bullish on it. I think you've gone from a scenario where many of the fintechs said, we're going to completely disintermediate the banking market. I think what many are realizing is banks have realized, hey, we need the fintechs because we're just not innovating and developing fast enough. But the fintechs broadly have also realized we need the banks because we need the access to capital, we need the distribution, we just need the global reach, right? So there's going to be a point in the middle where both come together, right? Right now, people are still kind of on separate sides, but long term, you can see that mold coming together. And net, it should benefit humanity.
Mark, jump in.
Yeah, I'm going to jump in. I think just on these 2 points around build, partner, or buy, I've seen banks do all three, actually, as opposed to an or, where they start with one and ultimately end up with the right mix. So like JP Morgan buying Nutmeg, or Goldman buying what is now Marcus, and they bought Clarity Money. They tried to do it. But I think another lesson from you, there was SVB that was mentioned earlier, is a lot of fintechs, we don't want to go into the business, for example, of custody. We want to differentiate much more on user experience. And the SVB fiasco was a reminder for banks to also, like, we want them to stay as banks and to play their role in safeguarding assets, and that's one of the most important roles, as opposed to when we've seen things becoming unclear and different risk management, that's where it hurts people, because the bank's main role, at least in our partnership, is to safeguard the assets. So we don't want to start to see banks going way outside of their scope as well into a riskier place.
Yeah, it's fascinating. I think what the opportunity allows for is the ability, particularly when you're working with large institutional things, is potentially how can you go further into new territories faster. So, for example, if you're partnering with Morgan and they're already set up in that jurisdiction and you've got a front end, I think a number of people here in the audience probably sit in multiple jurisdictions. They either have a headquarters outside the region and they're based here, or based in the region and they're looking to expand outside to grow market share. So particularly bringing in 70 countries, did you say, in terms of I'd be interested to see how you guys think about approaching products that, if it's a credit product, how do you approach licensing? Do you rent a license per territory? What are the obstacles you're having to overcome to be able to launch FinTech on a 70-country basis?
No, that's a great question. So what we have learned is that it's not even sub-regions, but every country has a unique setup for you to be successful. And that's what drives certain services which are commoditized, which is payment enablement, that we have a fairly globally scalable platform. But then again, what we have to do is make sure that we're integrating payment methods that are relevant in Bangladesh versus Dubai versus Korea. And so can we make it easy to do business with other PSPs, for example, on the payment side? In doing so, we rarely require to have a license in parts of Europe. Because of PSD2, we try and create these pay entities where we're able to ring fence the risk. But we do that only because we're required to. I don't think intentionally do we go into a regime where we're required to, where we're not required to take a license. So there we'd rather partner. When it comes to credit products, for sure, unless it's payment terms, right, which is a simple deferral.
It sits within a regulatory exclusion.
Correct.
A 4-in-4 payments, a 30-day exclusion.
Yeah. In our case, since we're small ticket and high frequency, the appropriate consumer product would be just something that bridges you till your next paycheck. Yeah. On the vendor side, or the restaurant side, as we described it, it's maybe a couple of weeks for working capital. Yeah. So in those areas, depending on the country, you may or may not be, sometimes you just have to register. And as long as you're able to be transparent with the regulators, which is what we do everywhere, in terms of what we're doing, and where required, we'll partner. And we'll partner with a progressive financial institution. So in heavily carded markets, which is a small subset of our markets, we'd rather just do a co-branded card. Because that's the right instrument for a majority of the consumers. But if I'm working in a low penetration market, then that's not the solution, because the bank that I partner with doesn't want to extend credit to a large portion of my base.
And Jason, we touched upon before that many people see regulated industries and regulators as the naysayers and the barriers to innovation. But we touched upon it actually being a superpower. And I'd love some of your insights about how being regulated and being open about that, being robust, is actually becomes a competitive market advantage.
Yeah, I mean, I embrace regulation at the end of the day. When you look at structured products, for those of you who have ever heard of a structured note before, you might be used to understanding the high fees, the lack of liquidity, the lack of transparency, the complexity, all things that our technology solves for. And ultimately, we've taken a very proactive approach with regulators, such as the SEC. I talked to one of the 5 SEC commissioners on a monthly basis, because there needs to be more education, like in many of our industries, right? When people have more confidence in the product or the solution that you're delivering, they'll buy more of it. And so if you're not doing anything wrong, in my respectful opinion, why wouldn't you want to embrace, the regulatory regime and being able to bring more oversight? We work with the FSRA and the ADGM, where we have our Halo MIA office. We couldn't do what we're doing today without actually a flexible, credible, and regulatory regime, say that 10 times fast, to be able to bring the next generation of structured products. So I think those who actually want to make it and survive are those who embrace regulation. Those who try to circumvent regulation, it might work for you in the short run, but it ain't going to work for you in the long run. And I think the SEC has given countless examples, at least in the United States. In the long run, is you want to be their partner, not their foe.
Mark, jump in, please.
Yeah, I think it adds to your question that you asked us earlier. When it comes to BNPL, is it bad for consumer? And that's where regulators play that role to ultimately protect the end consumers. When I started Sarwa, I share the same view as Jason, where we're very much pro and we've seen the benefit it provides us. What puzzled me was the variance where some people bash regulation, other ones will be very pro. And what I've learned in the last couple of years is that there's no such thing as a regulator. Like, there's ultimately the individual that is regulating the firm. And
so what you mean there is the case officer that's
Yeah.
at the regulator is far more powerful than actually the regulator themselves.
so powerful, and the unfortunate, well, that's changing in Dubai and UAE. There's less turnover. I think people are staying more, but before it was actually very disruptive to see different case managers come and go, and some of them have been amazing, some of them not so much. And the impact that has on the firm, or someone is relearning your case, especially when you're working on something innovative. I think now today I understand much more the variance between the views on regulator, because it ultimately depends on who's regulating you, and that has a big impact on your success.
And ultimately, people will vote with their wallets, right? So there's almost this self-regulation of, if they don't trust you and put credibility into the service that you're doing, like a Morgan Stanley, and like the software that you've created, they won't do business with you. And I think ultimately we are intelligent, but you just need to take that extra layer of regulation and regulatory comfort.
Well, I think there's a huge challenge in that because the speed of innovation, is that the regulators themselves, and we're regulated across every state in America and Canada, UK, Europe. Some of them don't even understand the fundamentals of what you're bringing to them. So rather than trying to ask the right questions, it doesn't look like what they've seen before. And as a result, they just say no. And there is certainly some, regulate the regulators. I can see, Mark, is what you're saying sometimes in terms of some of their lack of, when you're doing something very forward-leaning. But I think, as you rightly say, ADGM, DIFC have really got ahead of that curve. They've got exceptionally bright, talented people. They've worked a lot with regulators from around the world. I know the DFSA has worked very closely with the FCA and the sandboxes to try and bring a lot more of that forward thinking, and certainly compared with the United States of America, where not only do you have federal regulations, but you have to go and get state-by-state regulations to be able to offer programs, and you have state lines where you can't have a consumer in certain states versus other ones, that actually this region is so much further ahead of the curve than people give it credit for. And as a builder in both markets, I'd much rather build in the GCC than I would in the United States.
Well, that's why we picked, the UAE as our international headquarters, is because the flexibility, the credibility, and the scale that you can get both in DIFC and ADGM. We looked all over the world. Our global headquarters is Chicago. We looked in Singapore, South Africa, Canada, America, Europe, UK, Switzerland, you name it. And we found the UAE, and honest to goodness, it is the most, I think, efficient place to be able to do business. I have offices everywhere, so I have no incentive to say that. But it's the most efficient and scalable, and I think that's the power of technology like you deliver. You can do business all over the world from one centralized location, like the DIFC or ADGM.
I think it's also, in fairness to regulators around the world, it's also the objectives that they're trying to accomplish and their own context, right? So in certain emerging markets, if financial inclusion is a problem, then there will be a natural inclination towards creating regulation that is easier for FinTechs or even neobanks to solve differently. But I think the other objective here in countries like the UAE or Singapore or others is where we're also trying to create innovation hubs. And that's where it's relevant. While there are very developed markets in the US and Europe where they're solving a different problem. So I think what we find is that each country has a context within which we sort of will deal with the regulators as it makes sense for our business.
Fascinating. Now, Jigar, I'm going to ask you, just you and I here now, so no one else is here. What's the secret sauce? We tend to look to the biggest banks because they have the most firepower. What's the secret sauce? Where are you internally starting to think about? 2023, we're almost halfway through, so you're either hitting targets or you're not, or you're planning for 24. But I'd love to understand kind of where are you? What are your requests for startups? What are the things that you're demanding of your teams internally? Where are you placing your bets right now?
Sure, Tom. I think it probably goes back to, if you think about what 2020, 2021 was, it was euphoria. 2022 was a bad nightmare that people couldn't wake up from. And then 2023 is healing and moving forward. I think over the last 12 months, a lot of people have talked about, when things normalize, I want to IPO, or I want to do this, I want to do that. And I, in my sit-downs with founders, I usually question, well, define normal, right? It's all relative. The world is volatile. The world is complex. It's interconnected. There's always something to worry about. I guarantee you in the next few months, everyone's going to be talking about the U.S. debt ceiling, which they've already started to. So there's always something. And so what I like to do is, as we advise companies and founders, is let's focus on, okay, what objectives are you trying to achieve? How do you want to build this company thinking longer term? And let's be ready, whether it's M&A, whether it's buying something, raising capital, IPOing. You just got to have the flexibility to be able to be ready. And when these windows of opportunities open, because they can shut pretty quickly, you just have to be ready to go. And so, where we're focused internally is still, I tell founders I meet all the time, I'm like, now is a great time to start a company. I think people forget, if you go back to the great financial crisis, right, 08, 09 looked like the world was going to end. And guess what? In February of 2009, you had Square, now known as Block, founded. In March of 2009, you had Uber founded. And in early 2010, you had Stripe founded. And almost a decade later, these are great, iconic, FinTech companies known globally. And so if you're a founder now, I would say at the earlier stage, I'm focused on go raise that capital, go raise that seed money, go start a company, right? And there's so much talent coming out of the big techs that you can go do that. And then when it gets to some of the later stage companies or public companies, it's more about, okay, how are you gonna create that IPO event? How are you gonna get to that next stage now that you've pivoted your business model? Or how can you go from a 50 billion market cap company to $1 trillion? I think not too long ago, people questioned, could Tesla ever hit $1 trillion market cap? And it did. So I think people know that it's possible. It's how do you actually execute to get there?
And just very quickly, I just don't want that last. Do you sit there when you see the Goldman's team embedding with Apple, and do you kind of sit there and kind of think, does it make kind of smoke come out of your ears when they get the pathways to those deals? Or are you turning around to Google and saying, we can do the same for you? Because obviously, you wake up each day and either think, either I'm going to join Goldman's or I'm going to beat the shit out of Goldman. So, it's kind of, I'd be fascinated to kind of see when you see that level of innovation, does it frustrate?
Tom, it actually does not, because look, in full transparency, I do have a Goldman Marcus account, 4.15% yield savings. It's great yield, right? Yeah. So I do have an account. I think at the end of the day, it's where the broader theme I look at is embedded finance, right? I think many people, if you go back 5 years, they were afraid of big tech getting into FinTech, but the name that everyone was focused on was Amazon, not Apple. And guess what? Behind the scenes, stealthily, Apple launched BNPL, they launched mobile POS, they've launched now high yield savings, they have the Apple credit card. And so they've actually partnered with a bank to embed all the financial products. And so globally we talk about embedded finance, and I think that is like the best use case of that.
And then Jason, obviously as we go into a bigger pool, a bigger pot, as you said, that structured note market, the ability for people to be able to invest and start to understand these things. So is that something on your horizon whereby people could start to access your products potentially through other platforms? Is that something where you're looking to move to?
Yeah, absolutely. We're a B2B company, and so we power big banks and EAM/RIAs all around the world. But we're about accessibility. And so as we look at in the United States and many parts of the world, 50% of the US prefers to manage their own money and 50% prefer an advisor. if we're going to fulfill our mission of creating a positive impact before focusing on profit, and I say that's cyclical, we're not a charity, and so we could create impact, and impact creates profit, and profit creates more impact, is how we ultimately think about this. But we get approached all the time by the B2C companies, and that's something that we're thinking about, is how do we ultimately deliver protective investing solutions directly to the consumer, but do it in a safe way where it's not just about pushing and slamming as much product as you possibly can down someone's throats, doing it in a very responsible way where people know what they're doing, right? And so when you go and you look at an Apple, when you look at a Block, when you look at a Google, those are the next financial institutions. I don't think it's part and parcel of, is it Morgan Stanley versus Apple? I think that anything that Goldman does with Apple and anything that Morgan Stanley does with Block is ultimately benefits the overall ecosystem. It's a very collaborative ecosystem, which just gives all of us in the room more accessibility, whether it's to structured products, to equities, to alternatives, name your investment product. But this is the great integration, is what I'm calling it, over the next 5 years, is where Wall Street ultimately meets Silicon Valley. And all of that will benefit everyone in this room.
Yeah, and Tom, I just wanted to add to the point here. If you think about, right, in the US, we look at the stat of the number of bank branches, and they're declining every year. Yeah. And then the number of financial advisors, right, they're turning over. But everyone in their pockets through an iPhone or Android has a bank branch and a financial advisor with them. So it's how do you turn that into a tool? Yeah,
it's not mutually exclusive. And to that point, and to finalize your question, what we're doing right here in the region will lower structured note minimums down to $1. And so with our technology over the last 4 years, structured note minimums used to be $1 million. As you probably remember at Morgan Stanley, now with Halo, they're $1,000. And the innovation that we're bringing right here will bring those products down to $1. Does it move our needle? Absolutely not. But does it move our needle from an impact perspective and allow us to partner with a Marcus and partner with some of these other consumer fintech brands where even a dollar saver gets access to a better savings product? Absolutely. And that's ultimately where tokenization and blockchain and everything else, you'll be able to fractionalize that even to less than $1. And ultimately, I think that that's just what's so cool about the innovations and the plumbing that Wall Street has given us over the last 150 years to allow us to build a scalable foundation on top of that in regards to technology.
So building on that, Mark, and as we start to close out this session, when we're able to be able to serve that retail customer with that kind of dollar investment bit by bit, do you see that being the where the growth is in the region? It's serving that longer, smaller tail with your front end and accessing then the bigger products?
Yeah, I think so. I think it's about going where no one has gone before. So around 70% of our customers are first-time investors. So it's a very strong tool for us to go and serve these people because we're their first and primary platform. So as they grow, the hope is that once they are there's a term for it called high earner, not rich yet. And a lot of the segment, what the data shows is that you retain them. So they're not necessarily going to switch to a private bank or different institution as they grow and become richer. So that's where the opportunity relies in serving the mass affluent and the retail segment because they're way too expensive for a lot of the larger banks to serve.
And I think one of the things I'm most excited about as we move forward, and Anthony, I think you touched upon it earlier, so just finish this off, is the idea that what you can learn from the data, what you can learn from someone's spending habits, how they, as their income changes, they don't shop at Jollibee now, they go and shop at somewhere else. They move from McDonald's to the steakhouse, whatever it might be, and how you're able to understand and then influence that customer to come full circle, to be able to partner with a Salawa and start to save $1 per transaction or whatever it might be, because you've seen how that's. I'd be fascinated how you think about that, just to kind of close us out.
No, that's exactly it, right? There is a certain context within which we are with consumers as well as with restaurants or local shops, and that context builds with high-frequency usage, and that's where we have not just the data, but also the access to that flow, and that's where we partner with a whole range of players to deliver solutions that are embedded and we frankly make ourselves quite invisible, but we're then opening up access for a whole bunch of other financial institutions to serve those consumers.
Fascinating. So, ladies and gentlemen, I promised I would finish on time and that there'd be a break for lunch. I think what's, in that context, what's been incredibly insightful is that rather than a fintech versus traditional bank and who's going to eat each other's lunch, I think that what's been very clear is that there is a symbiotic relationship now with often those that are doing the front end and the neo-type solutions, relying increasingly on the big power of the big end providers, that through technology and innovation, we can bring down access to those products to $1 over the next kind of 12 months. And so that every day, individuals can start to save a little by little, start to invest in structured products step by step. But increasingly, because of the amount of data that we give the platforms that we use that we don't think are the obvious fintech platforms, that where we shop, where we do our fitness or whatever it might be, that actually the data that we get from that is going to help democratize access to financial inclusion. It's going to make things more affordable and more accessible for a broader base, which lifts more people up and effectively also delivers superior shareholder returns to those that have taken the risk and built the platforms. Gentlemen, thank you for your time. I've really enjoyed it. And ladies and gentlemen, a round of applause, please.
Thank you.
Thank you. Big round of applause for that fantastic